Good day, CTA candidates. Welcome to today's short video on financing decisions. In this video, we'll be looking at the study and exam techniques that are used to do an analysis of funding options, financing options, for you to be able to make a decision on which one is the most appropriate. So let's look at the questions required. We are asked to recommend. Recommend means we need to advise based on some form of reasoning or analysis. And so that advice has to be supported by some calculations or some discussion. In this case, we are recommending on the most cost-effective financing option for DPH. So in this case, it means we need to do the analysis of costs. We need to calculate the cost of capital and do a comparison. And in terms of that cost of capital, we know that we've got two options. We can use the IRR, which is a percentage, or we can use the net present cost, which is in rand terms. So we must decide which one to use. And that will be based on the information that is given. We are asked to ignore section 24I, which is basically foreign tax on foreign exchange gains or losses. Let's quickly look into the scenario, and I'm assuming in this video that you have read the scenario. So we've got this company that is renting construction equipment. It has some strategic objectives to achieve, which strategic objectives need money. It also needs to do some financing restructuring because it didn't meet the loan covenants for the current financing, and that loan had to be immediately repayable. Then they had to go out and look for funding to repay that loan and to pursue the strategic objectives. They have two options. One is an American loan in US dollars, and the other one is a South African loan in rands. Now, do we use NPC or IRR? We use IRR. Why can't we use NPC? Because one, the terms of the loans are not the same. One is 4 years, one is 3 years. And because also the loans are in different currencies, the starting point may not be equal. So NPC only works if the loans are for the same period and for the same amount in the same currency. So IRR will then be a better option to use in the analysis because IRR gives us the average cost per year. Now for IRR to work in this case, because one loan is in US dollars, we've got to identify all the relevant cash flows, calculate them, convert into South African rands so that we calculate IRR based on South African rands for both loans. So our cash flows need to be worked on. Okay. Now let's go through the analysis. The first step, of course, is to read with understanding. Know what information you are given, how the loans work. And then you need to draw up a timeline. In terms of your timeline, you are identifying the relevant cash flows that you will need for you to do that calculation, that IRR calculation. So we know for the American loan, it's a 4-year term loan, and we are going to have present value, which is the amount that we are getting. On that present value, there's going to be some costs, transaction costs, which we then have to deduct, and those transaction costs may have some tax implications. They are deductible for tax purposes, so we need to include those. Then the loan is payable in equal installments, so there's going to be installments every year for the next 4 years. Because those installments include interest, there's going to be interest tax shield in terms of section 24J that is applicable that we have to take into account. Okay. We've identified what cash flows we need for us to calculate our IRR. Now, we start tabulating those cash flows. First step is to identify what's the missing cash flow that we are not given. And we need to calculate that cash flow. So we know it's a 4-year term loan, so we know our N is 4 years. It's a $2 million loan. We know present value is 2 million. The interest is at 5%. We know our I is 5%. It's payable in 4 equal installments of capital and interest, which amount we are not given. So we know we are not given the PMT. And because capital and interest is paid every year at the end of the loan term, we will be owing 0. So we know the future value is 0. Now we've got to calculate this PMT. After calculating the PMT, for us to cater for the interest tax shield, we've got to then invoke second function amort for each period from year 1, period 1, 2, 3, and 4. For each period, we need to then get what is the interest, which will be our A in the Section 24J formula. And this A will be the interest that is deductible, on which we then apply the tax rate in order for us to get to the interest tax shield, which is the cash flow, the amount of cash flow by which our tax is reduced. Once we've calculated all the cash flows, tabulated them, we get the cash flows, the net cash flows in US dollars. Remember, we said in principle, the analysis, the IRR should be based on rand cash flows for it to be comparable. So we then have to do a conversion of those US dollar cash flows into rands in order for us to calculate the rand-based IRR. Similarly, for the second loan, we start with the cash, the timeline. It's over a 3-year period. We identify the cash flows that are applicable. We know we're getting the 37.5 million. No payment is made throughout the loan term except at the end, where we pay the future value as a bullet payment, which would be the present value of the loan plus the interest in total. Because that interest is charged over time, but it's only paid at the end, we could still have interest tax shield in terms of Section 24J as well. And there are costs that we must deduct at the beginning of the period, which will also have tax implications. So we've tabulated these are the cash flows that we need for us to calculate the net cash flows and then calculate IRR. What information are we given? We are given the period. The term of the loan is 3 years. We are given the starting value that we're getting, the cash that we're getting from the bank, 37.5 million. We know nothing gets paid throughout, but we do get the interest tax shield because that's how Section 24J works. We know the future value that needs to be paid, which is the principal plus the capitalized interest over time. So what we do not have is the rate and the loan rate, which we then need to calculate. Okay. And then from there, we invoke that Section 24J second function amort, similar to what we've done with loan 1. So let's look at how it has been done. You can see first, after having tabulated their timeline, identifying what cash flows are required, then we identify and calculate the missing variable, which will in this case be the PMT. From the PMT, we can then invoke Section 24J second function amort on your financial calculator to get to the interest and the interest tax shield. Then the cash flows are then put in a table, converted into rands, then IRR is calculated. So we get 11.11% for the American loan. For the South African loan, the missing variable was the interest, which we then calculate. We've tabulated in terms of the timeline, how long the loan takes. We've identified the applicable cash flows. Then it's a matter of then putting them in a table to do that analysis. So after calculating the missing variable, which is the interest, then we can then invoke that second function amort for us to then call out the interest, on which we will then apply the tax rate to get the interest tax shield. Then the rest of the cash flows are put in. You can see we've got the loan, the cost of the transaction cost, initiation cost of the loan, tax benefit on the initiation costs, the tax advantage, which is the interest tax shield, which is based on section 24J, and then the bullet payment. Then we calculate our IRR, which is 10.86. So based on this, it shows that it looks like the loan, the cheaper one, is the one of the South African bank, which is 10.86%. That's how you do then the analysis, quantitative analysis, the calculations that you do. Okay. In terms of qualitative analysis, where you do the discussion, there are many considerations that you can look at in comparing the two loans. So that would be your homework to say, quantitatively, we selected IRR, which IRR is based on the cash flows in rands, and we were then able to compare the two percentages. But in terms of qualitative, in terms of discussion, what are the factors and forces that you would consider in your analysis in order for you to make a decision on the law? So that's it in terms of your analysis. You can see this forms part of sources of finance, and we calculate the cost of capital, financing decision. We also apply foreign exchange rates, so it touches into treasury in terms of analysis, the principles that we applied to be able to do all those calculations. Firstly is the matching concept. We had to match the two loans in terms of comparability using IRR based on the net cash flows that are in South African rands for both of them, and they had to be after tax because we took section 24J into account for both loans. For the two loans to be comparable, we applied section 24J using our financial calculator. After identifying the missing variable, we were then able to invoke second function amort on our financial calculators. Then after having matched the cash flows in terms of net cash flows after tax based on rands, we then calculate the cost of capital to do the comparison. The tools that you need to maybe revise if you struggled with how the calculation is done: some time value of money. You saw we calculated PMT. Then we went on to invoke second function amortization. We also calculated the interest, then invoked second function amort. Then we calculated based on the net cash flows in rands. We calculated the IRR. So that's another calculation that, in terms of time value of money, you've got to be able to do. The conversion, how to use the exchange rates. So finance and cost of capital, what's the process that we followed to choose IRR instead of using other methods like NPC or market value? How did we go and say this is IRR that we are going to use? What informed that decision? Okay. And lastly, financing decisions is one of the important topics, so you've got to master this topic. It has been assessed regularly in the ITC and IAC, and in terms of the diversity of questions, it's not always calculate. In this instance, we had a recommend, and that recommendation had to be based on calculation. So familiarize yourself with the various instruction verbs that can be used, and also take into account that it could be asked in terms of calculation or in terms of discussion. Thank you for watching, and all the best in your studies further.